But the question is, has all of that been factored enough by the market now? And from here on, do we expect a recovery, or do you expect this pressure rally to continue and the sideways move to be the nature of the market for the next couple of months?
Yeah, I think the market would be watching the earnings most importantly. I know there are a lot of macro factors like strong dollar or China recovering, which is also playing a role in Indian FI outflows and the market being sideways. But I think the most important is the earnings growth rate, and that also has not been going as per the trajectory which we had thought at the beginning of the year. At the beginning of the year, Nifty 50 EPS growth was likely to be 12%. Now we are down to 6% for this year. So while the next year forecast is 16% growth back again, the as we come closer to March, I think a real hard assessment of where the fiscal 26 Nifty EPS growth is going to land up is going to become extremely critical in my view. Until that time, it could be just wait and watch, very stock specific move. The other broader point I want to make is that the market has shifted away from thematic sector based movements to stock specific movements now, and therefore I also expect that even while the markets will remain sideways, I think the nature of the market will be very different, and it will be very bottom up stock selection rather than the sectoral swings or the sectoral moves which we saw in the last 24 months.
Right. As you were mentioning that the FY25 EPS for Nifty would be very critical. How do we end up now? So far, from the start of this financial year, we have at least seen a 13% cut to the FY25 EPS that was predicted at the start of this financial year. With H2, are you expecting a recovery to happen? Any upward revisions that could happen in the EPS?
Well, it's a mixed bag, but on the whole, while the cuts have happened, I don't see any triggers for the upgrades to start happening soon enough. And therefore, we'll have to wait till the next year, in my view, for any kind of sustainable earning upgrades, if at all we were to see one. So, no, the answer is no, I don't see that happening in the next 3 to 4 months, the remaining part of this fiscal year.
Okay, so that's the take coming in on the market right now on some of these individual sectors. But if I had to ask you, Rahul, to take a call on consumption specifically, because there are different facets of it now, right, from an auto to an urban consumption to a rural consumption, travel, tourism and whatnot. What within that will be the pecking order of yours? What within consumption would you look at buying first?
So I think clearly, consumers are spending more on experiences rather than on products and lifestyle or FMCG. So clearly there is a K-shaped even within consumption. And I'm not talking about urban rural here. I'm talking about the categories of spending which are growing faster versus the category of spending which is not growing at all. So we are obviously focused on that movement. Apart from that, as I mentioned earlier also, I think it is also becoming a very bottom-up market. There are a lot of companies over the last 2-3 years which have gone through a slump, which have gone through a period of slowdown or a decline in their growth. And that, company by company, we are seeing some signs or some initial signs that we can start to look at some of those companies where either the management is undertaking a pivot in terms of their strategy, or just the base effect somewhere. Some places have become very, very strong to support growth, and I think valuations by and large have been drifting down. So valuation comfort is slowly come back in some of those names. So clearly strong franchises which have gone through 2-3 years of a slump, and with valuations being more reasonable than what was the case 2-3 years back, those stock specific picks in consumption would also start to emerge in our view.
Right. So as I can see in your mid cap growth fund and your large cap growth fund, you don't hold much of an IT names in that. But even in this market fall, if you see, the IT sector's performance was much better compared to what the benchmark or other sectoral indices we had seen, the fall that we had seen. The IT sector had fallen much less compared to what the others had fallen. Also, how are you, any specific reason why you're not holding many of the IT names in your portfolio?
Yeah, I think IT as a sector has bounced for sure, and there's no doubt that there is an expectation of US recovery or corporate tax cuts in US leading to IT spending recovery in US. As far as companies are concerned, we are not seeing that happening immediately. Like I said, maybe it's an FY26 story. So it's something which we are waiting and watching and on the sidelines, given that the valuations are no longer as cheap as they were, probably 7, 8 months back. So the valuations have caught up. The outlook and the estimates have not yet caught up, and therefore we are, we have to watch this a little closer and on the sidelines rather than trying to be very aggressive at this point of time.
Okay, so not looking at being very aggressive when it comes to the IT sector, that's the view coming in. But financials, what's the view on that? Because even before Q2, that seemed to be the consensus trade purely because those stocks hadn't run up. And on a risk-reward basis, that was where people were hiding and finding comfort in. Now, after a bit of a correction, would you buy into some of these large cap financials or the public sector financials, or you are too worried about the asset quality issues which are emerging on the horizon?
No, definitely. I think the asset quality issues have been nipped in the bud by RBI fairly early, and it impacts certain NBFCs and certain smaller banks much more than it impacts the larger banks. And when I say larger banks, it includes both private and PSU. So clearly, from a valuation perspective, the large private sector and PSU banks are looking quite reasonable. And the other issue is that as we have seen the earning downgrades happening in the rest of the sectors, banking sector has by and large, barring one or two accidents specific to the banks, by and large the sector has performed in line or slightly better than estimates. So when we look at FY26 and we look at a 15-16% growth in the market, suddenly the gap between the bank's earning growth rate and the rest of the market earning growth rate is not that much, which was the case in FY22 and FY23 and part of FY24 as well. So even from a relative perspective, what we are seeing is that the bank earnings are not going to disappoint as much, whereas the rest of the sectors have continued to disappoint. And therefore, from a relative sense, with the valuations where they are in the banks, I think it becomes a much clearer bet today than it was 6 months back. 6 months back, we only had valuations to support. Now we have valuations plus the fact that we are much deeper in the journey for a slowdown in banks. And I think there is coming a point when even the LDR ratios, etc., are coming back on track where the banks wanted it, where the regulator wanted it. And therefore, next year, when we are looking at next year, the at least the credit growth will be equal to the deposit growth, if not more. And with the fact that the rate cuts have not happened, and in the US you can potentially have also a little bit of a delay in the pace of rate cuts, clearly bodes well for the margins as well. So all in all, the disappointment in earnings for banks is going to be fairly limited, and the valuations are pricing in a lot of negatives already. So yes, I think the timing is working out perfectly now.
Right. And how are you looking into when it comes to names like beaten down names like cement or the chemical space? At least reports are suggesting that there could be a recovery for both the sectors, given the fact that government capex is expected to pick up, which would benefit the cement space, while inventory issues are expected to normalize now for the chemical sector globally.
Yeah, I think chemicals is it's been a long down cycle, and until the time the Chinese overcapacity does not go away, it's difficult to pinpoint and say, because it's deeply cyclical. It has behaved, even the specialty chemicals part of it. Even the best of the companies have gone through this deep cycle. So clearly, the myth about some of these chemical companies being secular growth stories has been broken, and I think that's the hit which the market is still absorbing. As far as cement is concerned, it's a long-term story. I think long-term it looks really good because valuations are decent. Near term, obviously there is going to be some pricing pressure. There are expansion plans by the bigger groups. So obviously there is going to be a market share and pricing pressure, which will put pressure on the profitability. But from a volume growth and eventual recovery once consolidation happens, the sector is looking quite attractive, but from a 3-year perspective.
Okay, so that's the take coming in on cement sector as well. From a 3-year perspective, that might be looking still good. And Rahul, last question before I let you go. We were reading this morning a note coming in from Citi who talked about that for September 25, their target on the Nifty is just around 25,000. Yeah, it's 7% higher from the current market price thereabouts. But if you look at the high that we had made, 26,200 thereabouts, they're clearly expecting that wouldn't be scaled back in a hurry. What's your own expectation, let's say at the index level? What's a realistic return expectation one should have?
Yeah, I would not like to focus on the index because, as I mentioned at first only, that we are going to have a period where markets will be in wait and watch mode. It's very difficult to give you in a range bound market what could be the upside on a 12-month perspective or downside. It's pointless to give that prediction. But what I can say is that what I said earlier also, that it will become a slightly narrower market. It will become focused on valuation. It will become more stock specific, and you will see less of sector movements, but more of stock specific movements. So if I were to remind you, between November 2021 to March 2023, there were exactly 18 months of very similar phase which we saw. So it has happened not so long back, and we should not forget that a similar kind of period can repeat, whether it's 6-month long, 12-month long, 18-month long, and in between whether there are interim peaks and interim bottoms. It's very it's very difficult to say, but it's happened just very recently, and therefore we should not be surprised if it happens again.
Have it right. You recently launched a new fund, an NFO that came to the market, but do you anticipate that the rate of new NFOs is going to kind of ebb a bit, or do you still see retail participation being very strong? What's your sense on the kind of flows that you have been getting?
Yeah, it's not for me to comment on the NFO pipeline of others, but we've obviously come up with the innovation fund mainly because we want to build a bottom-up portfolio, and I think the current market conditions would suit it because we have come to the end of a thematic movement period in the market, and therefore the alpha today will be generated more by buying good companies and good managements at reasonable valuations rather than blindly buying any particular sector. As far as the inflows by and large are concerned, they have been steady so far. Even in this correction period, I think retail investors flows led by SIP has been quite steady so far.
For joining us and giving us your perspective about the markets going forward.
Enviro Infra Engineers Limited now proposes an initial public offer of its equity shares. The 100% book built issue is being offered at a price band of Rs 140 to Rs 148 per equity share of face value of Rs 10 each. Issue opens on Friday, November 22nd, 2024. Issue closes on Tuesday, November 26th, 2024. For risk involved and other details, please refer to the Red Herring Prospectus, which is available on the website of the company, SEBI, stock exchanges and the BRLM, Hem Securities Limited.